what you see is that 5 waves carries the same message as 9 waves, which carries the same as 13 waves, and that works forever. Now, there are a different set of numbers for corrective waves, as we'll see this afternoon. But that's been a very helpful little tool in counting. Extensions occur in one and only one of the impulse waves, and that can be a big hint to the subsequent wave development that you expect to see. Let's take a look back at page 2.4. There are a couple of guidelines as far as extensions are concerned. After you've got an extended wave 3, such as you do in this case, you would look for a normal wave 5. Now, by normal, I mean it would be either equal to wave 1 or related to wave 1 by the Fibonacci ratio, and we'll talk about that more in detail later on. Additionally, if waves 1 and 3 are simple, in other words, if neither wave 1 or 3 is the extended wave, you should expect an extended 5th wave, especially under the instance where volume in the 5th wave is greater than the volume that you saw in the 3rd wave. That can be a very big tip-off. That's what you see here in this example. Waves 1 and 3 were basically simple. Wave 5 is the extended wave. Now, the extension itself, since it is a 5-wave structure, can also contain an extension within an extension. Let's take a look at page 2.5. Here's an example of a 3rd wave extension of a 3rd wave extension. In this case, primary wave 3, 3 in a circle, is the extended wave. Within that, intermediate wave 3, parentheses wave 3, is also extended. Page 2.6 is an example of a 5th wave extension of a 5th wave extension. All right, now this is not a chart that's in the workbook, and it just about fits on the overhead. This is an example. Actually, this is what Frost and Prechter drew 10 years ago, over 10 years ago, as a textbook illustration of an extension within an extension within an extension. Page 2.7 is this picture occurring in real time. I'm sure many of you are familiar with this picture. What we need to do, add an intermediate wave 4 down here, and then come up here just over 1900 again, and add an intermediate wave 5, completing primary wave 3. We did that, and then the market proceeded to do that, so that worked out real well. Frost and Prechter drew the picture 10 years ago. Here it occurred in real time just about 2.5 years ago. What you see here is an extended minute wave 3 within an extended minor wave 3 within an extended intermediate wave 3. We'll come back and talk about this picture later on. That's pretty much it for extensions. Let's take a look at page 2.8. Now here's something that you need to keep an eye out for. It's the concept of a failure within a 5-wave structure. Sometimes the 5th wave fails to make a new extreme beyond the 3rd wave terminal point. We've called them failures. It's really a bad choice of words, although I'll probably continue to do it since it's ingrained in my speech. They're preferably called a truncated 5th wave, because that's really what it is. It fails to move beyond the end of the 3rd wave. It is imperative that the 5th wave contain the necessary subdivisions to qualify it as an impulse wave. And this in turn will help verify your wave count. Now, failures are not uncommon, especially in waves of small degree. That's nice. Why are they important? Because they give an important warning that you're dealing with a market where there is either underlying strength or underlying weakness in the market. In a case of a bull market failure, when wave 5 fails to exceed the peak of wave 3, we're dealing with a market where there is underlying weakness. In a bear market failure, where wave 5, in this case, fails to take out the end of wave 3, you're dealing with a market where there is underlying strength. All right, now what's wrong with this lower picture? Well, if this is a corrective pattern, and it ended a bear market, and we're going to go make new highs in here, what do we know about corrections? They're never 5-wave structures in and of themselves. A portion of a correction can be a 5-wave structure, but the correction itself cannot be a 5. So this must have been, in this example, the end of a C wave. And that would be acceptable. Let's move to page 2.9. Page 2.9 is a real-time example. This is the stock market back in October of 1962 at the time of the Cuban Missile Crisis. This correction, by the way, ended primary wave 4 of cycle wave 3. But let's take a look at it a little more closely. Notice that wave 5 of C does not come down and take out the low of wave 3. All right, well, maybe it's a failure. What do we need to check? Let's see if it's got the requisite 5-wave structure, and it does. I've seen this on an hourly chart, so I know it can be counted in this fashion. But this is a very nice 5-wave decline. Now, A.J. Frost caught this low, diagnosed this as a failure, and had that low. What was going on back in October of 1962? As I said, the Cuban Missile Crisis. Well, what did the failure tell you? This was horrible news that this was going on and the country was in turmoil, and we'd pretty much been in a declining market for a year and a half at least. Well, once you saw the failure, the market told you that it was a market that had underlying strength. That's why wave 5 was unable to come and take out the low of wave 3. What took place? Over the next 3 years of uninterrupted bull market that followed from this low, the market roughly doubled as it went from about 550 to a little over 1,000. That's the message that you can get from a failure. Let's take a look at page 2.10. We'll take a look at the top chart first. What we're looking at here is the peak of the 5th wave relative to the peak of the 3rd wave. None of the peaks within the corrective waves are important to us. Wave 5 failed to move above the end of wave 3, which is a failure, and that indicated a market where there was underlying weakness, since it's occurring at the end of a bull market. And you've got the necessary 5-wave structure, again, within the 5th wave. So you've satisfied everything you need to do. What took place? Well, over the next 10 months, the Dow was not even able to mount one 5% rally, which was not a market that I would have liked to have been trading. And that's the message that you can get from a failure. We'll come back and take a look at the bottom of this page in just a moment, because if you notice, there's a diagonal triangle there, and that's what we're going to talk about next. We're on page 211. We've mentioned rules several times. Wave 2 cannot exceed the origin of wave 1. Wave 3 cannot be the shortest wave. Wave 4 cannot overlap wave 1. The only true variation in style to this is the diagonal triangle. Because in a diagonal triangle, each wave subdivides into a 3-wave structure within the diagonal. Now, diagonal triangles typically occur after a substantial move. Don't expect to see a diagonal triangle after a short, stubby type move. They appear in a very logical place after the market has moved too far, too fast. In a diagonal triangle, wave 4 can overlap wave 1, and it usually does. I would come just short of saying that it's a requirement, but I can't think of any good diagonal triangles that we've counted where wave 4 did not overlap wave 1. You can see that right here. Wave 4 comes down and overlaps the price territory of wave 1. Usually, a diagonal triangle will develop a wedge shape between two converging lines, as you can see on the diagram. although occasionally you'll get a reverse wedge shape. We'll see a couple examples of that, but they're very uncommon. Now, diagonal triangles are very emotional patterns, and they are sometimes characterized by a burst through the trend line when the fifth wave is completing, and that is usually typified also by very poor market action, poor volume, churning, poor advanced decline statistics. Why are diagonal triangles important? They are highly reliable patterns for timing. They usually precede very sharp moves, and they often indicate the exhaustion of the trend not only 1 degree higher, as is normal for any 5-wave structure, but also 2 or 3 degrees higher, which means you could be getting ready for a very important move. Diagonal triangles are ending patterns. They are finishing something. And the subsequent moves are quite often sharp and dramatic reversals. Let me just mention one reason. If you think about this, it makes sense that wave 4 comes down and overlaps the price territory of wave 1. If the individual waves within the diagonal triangle don't have enough strength to trace out 5-wave structures, that argues that the entire pattern itself is one of weakness. Let's take a look at a couple examples. We're on page 212. Now, the chart at the top of the page is a chart of the American Stock Exchange Index, and the period that we're looking at is back through June and July of 1986. Diagonal triangle occurred here after a substantial move. Each one of the waves within the diagonal triangle subdivided into a 3-wave structure. They were clearly not 5-wave structures. You've got converging lines that were typical. What happened? Now, a diagonal triangle is an ending pattern. It's supposed to indicate a sharp reversal. Well, the American Stock Exchange lost 10% over the course of the next month. And that would be a nice move to catch. This chart at the bottom page is an example of an expanding diagonal triangle. Each wave subdivides into a 3-wave structure. The lines diverge in this case. And what this completed was the February 1980 peak, which led right into the Hunt-Silver debacle. Over the course, this said it's an ending pattern. The fact that it's a diagonal triangle that completed. And it said, look out, you might be due for a sharp, dramatic reversal. Well, over the next month and a half, the market lost 170 points on an hourly basis. Now let's go back and take a look at the bottom of page 210. Let me just point out very quickly this little failure here that occurred at the end of this diagonal triangle. That can be a very powerful combination. And here's a classic example of it, the bottom of page 210. Here's a diagonal triangle that completed primary wave 1 of cycle wave 5 back in January of 1984. But within the triangle, wave 5 failed to move above the end of wave 3. So what do you have? You've got a failure within the pattern which tells you there's underlying weakness in the market already. You've also got on top of that a diagonal triangle which tells you that an important pattern is ending. It is probably ending now, and you can expect to see a sharp, dramatic reversal. This is a very powerful combination, and when you see something like this, especially at this degree, it carries a very important message. The market lost 160 points over the next month and a half in this case. There are times under Elliott when the picture is very, very clear. Other times, when you're in doubt, you should do nothing because these occurrences will take place. Let's flip ahead to page 213. This is from, I believe, the August issue of the Elliott Wave Theorist. What we're going to concentrate on right now is the right-hand portion of this chart. Here's a textbook illustration of a diagonal triangle taken from Elliott Wave Principle. Here was the market action in late June, early July of 1986. Notice the converging lines, the 3-wave structure. Wave 3 here is a double zigzag. We'll talk about those later. In each of the waves, wave 4 comes down and overlaps the price territory of wave 1. what took place afterwards. This pattern said we're finishing a pattern at least 1 degree higher, possibly higher, expect a sharp dramatic reversal. And we'll take a look at this page later on. This is page 251 in your book, but I'm only going to spend a moment on it. Here was the end of that diagonal triangle we just looked at. Here's the subsequent action. Sharp dramatic reversal. At this time, when this occurred, this was the largest single down day in terms of points in stock market history. All right, now we've taken a look at diagonal triangles as they occur in fifth waves. Let's take a look at diagonal triangles as they occur in C waves, because it's also permissible for diagonal triangles to occur in that position. These are charts of the stock market, 1980 through 1982. The top pattern completed primary wave D of cycle wave 4. This occurred basically 1980 through 1981. And here's a diagonal triangle occurring in the wave C position. Each one of these waves is best counted as a three-wave structure. The lines converge. The pattern suggests that you're going to see an important reversal of trend. As a matter of fact, this is what the market did over the next 3 months. And interestingly enough, this completed primary wave E within cycle wave 4. Let's take a look at the diagonal triangle within C, waves 1, 2, 3, 4, and 5. And each one of these structures is best counted as a three-wave move. Now remember what we said about the exhaustion of trend several degrees higher in regard to diagonal triangles. Because this last diagonal triangle here, which completed primary E of cycle wave 4, ended the 16-year bear market that lasted from 1966 to 1982. It was followed by the biggest kickoff rally in terms of momentum in over 40 years. That's the type of significance that a diagonal triangle can carry. Now, diagonal triangles themselves are rare. You don't see them all over the place. This is page 215. But a pattern that Bob observed several years ago, and we've actually seen several of them since then, is what we refer to as a diagonal triangle type 2. And let me also add that this is the only new pattern that we've seen in over 12 years of real-time analysis of the markets, and felt that it was a valid enough pattern to add to the catalog of patterns that Elliott gave us 50 years ago. These are rare patterns. Let me show you the difference between this and a diagonal triangle type 1. The odd-numbered waves, 1, 3, and 5, subdivide into 5-wave structures, unlike diagonal triangle type 1s, which subdivide into 3s. They still converge, and wave 4 still overlaps wave 1. Now, there are only several known occurrences of these, but interestingly enough, they have all occurred in wave A of an ABC rally, which was part of a bear market structure. And what that means is that each one was preceded by a very strong decline, and each one was eventually followed by another strong decline. So ultimately, these patterns imply weakness too, just like diagonal triangle type 1s. Let's take a look at page 216. The chart at the top, as it says, is a chart of the Dow hourly, November through December 1979. This was preceded, and let's take a look at the subdivisions first. This was best counted as a 5, 3, 5, 3, 5, as is required by the pattern. This advance occurring in an A wave was preceded by the October massacre in 1979. It led to a little further rally up here when we completed wave C. As a matter of fact, we looked at that a couple pictures ago when we saw the expanding diagonal triangle that peaked in February of 1980. And this was ultimately corrected by another strong decline, that being the Hunt debacle